So the big question is this: how do real estate investors who don't have a ton of free time, don't have access to off-market deals, and didn't start life on third base, how do we conservatively grow our real estate business to support our families, finally leave the corporate rat race, and build a legacy? That is the question, and this podcast will give you the answers. I'm Ed Matthews, and this is Real Estate Underground. Greetings and salutations, Real Estate Undergrounders. It is Ed Matthews and the Real Estate Underground. Thank you so much for listening. As always, if you get a lot out of this interview with my friend Ben, we'll get into him in a second. Please like, share, follow, and subscribe to this podcast. So Ben Fraser from Aspen Funds, thank you so much for joining us today. It's really good to see you, my friend. I've been aspiring to get into your business for a while, and I'm pretty darn close. I'm a few days away. But, I've been paying attention to your business for quite some time, and it's a pleasure to have you on the show. Thank you.
Yeah, thanks for having me on, Ed. Looking forward to chatting, man.
So I know you because I stalk you on LinkedIn and a few other places. But, for those folks that aren't familiar with you and your firm, why don't you lay out who you are and what you do?
Yeah. So I'm the Chief Investment Officer at Aspen Funds. And so Aspen Funds, private equity firm, probably a lot like you. We have a few different verticals we focus on, and really actually started about 11 years ago, coming out of the last last recession, and found a unique opportunity in distressed mortgages. So, a lot of us wanted to hit the delete button in our brains back then, but you may remember there was a lot of distressed mortgages, coming out of 08, 09. And
Simple.
Yeah, it was, from a timing standpoint, getting the market is a good timing. You could pick up these mortgages at very deep discounts and really carved a niche out there. So been doing that about 11 years. We've purchased well over 5,000 mortgages in all 50 states. Wow. And continue to operate that as a core business line. But as with most investments, things go through cycles, right? And so it's something we continue to grow, but it's a shrinking market in the sense of, for us to grow, we have to keep pushing out other competitors. And so it's a harder business to stay in. But what really allowed us to do is have a pretty unique perspective into the market. And then many years ago, kind of shifted our approach to, hey, what worked well with our approach in, coming into this opportunity in the last cycle and understanding the kind of macroeconomic factors driving the opportunity and coming in at the right time has helped us form our thesis for other verticals that we've now built out, and really leveraging kind of our macroeconomic research, some of our kind of top-down analysis to understand where do we think the next good opportunity is going to be, and how do we position and build out the vertical, build out the internal teams or external partners to do that. And so we have about 4 primary verticals that we run right now, mostly in real estate, but also in energy investments. We do a lot of energy investing as well. And we're seeing a pretty big opportunity right now. Debt's a great place. And I know you said you're about to launch a debt fund, which is awesome. We think it's a great option for investors that are looking for yield and want to kind of reduce their risk of capital loss, especially right now where there's a lot of turbulence going on in the commercial real estate markets.
Bit choppy.
Going down the capital stack makes a lot of sense. Get yield, protect capital, and depending on how you structure the deals, potentially even get some upside if they perform. And so that's where we're seeing a pretty big opportunity, and happy to chat more about why we think that is. But that's a little bit of the background, and my role is CIO, so I do a lot of the acquisitions, also run a lot of the capital markets, so help raise capital and form the debt and the whole capital stack for all of our funds.
So walk me through what a target acquisition would look like. How much distress, what's the size? Obviously you operate in all 50 states, so we don't have to talk about geo, but no, I'm just curious what a deal looks like for you specifically.
Yeah. So it's evolved, right? When we started in the original debt fund that we continue to operate, we had 2 different strategies. One was buying non-performing mortgages. Yep. And then having some kind of exit strategy, usually one of 5 options. That the worst, or not the worst case, the last case that we would kind of go after would be the asset. We would try to work out a deal with the borrower, get them paying again, get them back on track, do cash for keys, do all these different kind of strategies. But we have to take back the property, we will. And then we had another fund that was a reperforming mortgage fund. And so what ends up happening most of the time with these non-performing borrowers is they want to stay, they get back on track, and they start paying again, but banks can't hold these mortgages because they have to risk rate them higher, compliance reasons. It doesn't make sense. So we can hold those for yield. And so we've kind of built a nice big pile of assets that are producing a nice yield, and they're performing mortgages. So it's distressed in the sense of they had a historical, blip on their payment stream, and we, can manage around that though, usually from, our basis and equity protection and different underwriting things.
Okay.
What's kind of evolved. That's been a business we've been operating for over 10 years now. And we've kind of taken that same approach where we've really learned it. That's all residential housing, all kind of consumer owner occupied mortgages. And we've shifted the approach toward more commercial opportunities, because we're seeing a similar thing happening that we saw in kind of the last cycle where, credit tightening cycle, where banks are not wanting to lend as much, investors are reticent to put more cash into deals. And it's creating this huge gap where, good deals, good locations, they have a clear path to stabilization, or they have a clear path to make it to that next point to where they can hold it and get through the kind of turbulence here. They need a capital injection. And so that's really where we're seeing a huge opportunity. And because there's less capital availability, we can drive what we think are much higher risk-adjusted returns and still stay lower in the capital stack, preserve capital, reduce risk of loss, but still earn pretty high yields because what the market's kind of driving right now.
So, I'm curious about size of deals. Obviously you probably live in the, 7-8 figure world, but, I'm curious about, the smallish end deals, right? The, the $1 million, $2 million portfolio deals where somebody that owns, I don't know, 50 units gets into a little bit of hot water. Is that too small for you, or are you more focused on something else?
Yeah. So we have a fund. So the advantage of a fund is we have the committed capital to go and be flexible and be quick to move. And so, because a lot of people are seeing the same thing we're seeing, right? Of where there is some stress, there is credit tightening, preferred equity opportunities, mezzanine debt opportunities are becoming a lot more common. Well, what we found is that most bigger players at our size and above will only do a deal if it's $10 million or more. Right. They don't want anything less than that. And the reason is the overhead to do a small deal is pretty much the same as the overhead to do a bigger deal. And they make 10 times more money, right? On a $10 million versus $1 million. So why would I go do a small deal? But what we found is because most of those are not usually funds, they're kind of individual syndications, or they're kind of go raise the capital for that deal. And so what we're doing is, because we already have the capital and we can kind of reduce the overhead, we get economies and efficiencies through rinse and repeat, some of these smaller checks. We're actually targeting sub $5 million checks. So usually a $1 to $5 million capital injection. And that allows us to play at a part of the market that is less efficient, has less capital availability. It allows us to negotiate good terms, but also provide a solution for borrowers and sponsors that have good assets, have good deals. Then something just didn't go according to plan, because hey, there's a lot of that going on right now with interest rates where they're at, and construction and labor and rents and all these kind of things.
Right. So that makes a lot of sense. So instead, you're counting on doing more deals rather than larger deals, at least in that space, right?
Exactly.
And so when you look at a potential opportunity, Ed comes along and says, hey, I've got $4 million in assets across 10 different buildings, and I'm in trouble here, 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 and here. What happens next? Is it one asset that you're looking at, or would you take this at a portfolio?
We generally look asset by asset, right? We're not buying any kind of securitized portfolios. We're not investing in pools, right? We're investing in individual deals, and we usually want to be straight directly to the asset, or directly to the borrower of the asset, and get some kind of pledge, either pledge of collateral of the asset if we're going to be secured, or pledge of the membership interest in the borrower. So if it doesn't work out, we have some kind of recourse.
Right.
So yeah, we're looking straight to the deal. And, if you're looking at an existing deal that is struggling, it's either going to work or it's not going to work. Right. And so you can usually pretty quickly establish, what I call a basis problem, which is just you paid too much for it. Right. And there's probably you should probably just realize your equity is probably wiped out if you have to sell right now and move on, or maybe there is a way we can stabilize it. So we've seen a lot of those deals. We got to preserve equity. You got to, hold on and see if we can make it through. And the reality is a lot of those deals might not work, unfortunately. And so it's, sometimes the line is a little bit fine, but there are a lot of situations what we're seeing where, and most of those deals are ones that have floating rate interest rate debt, right, in the Sunbelt market that had aggressive business plans. That's the common theme is, deals that can't be rescued. But there are deals that say were purchased in the past couple of years and they actually have fixed rate debt. So they actually have good low rate debt, but they got surprised with insurance. They got surprised with property taxes. They got surprised with occupancy and problem with the property manager that, screwed up the business plan. So they need a capital injection to say finish their renovation program, but they don't want to go get a refinance and they have enough equity in the property to go get new debt, but it's way more expensive now. So, hey, we can come in behind that really good debt, help finish the business plan. It's not even really distress, so to speak, but it kind of solves that need of not wanting to go back to the capital markets when they're a lot more expensive now. And the weighted average cost of capital, even with us being a little more expensive than traditional debt on a smaller amount, actually helps the deal out and gets them kind of that stabilization.
So say I own a $3 million asset. Let's go with the property manager. The property manager blew the deal, in terms of executing on the strategic plan. I now need to raise 250 grand to be able to stabilize the additional units. Am I creating a deal that looks like the one you're targeting, or yeah? Okay.
Yeah, just make the 250 $1 million, but
okay, done.
You're exactly right. And the challenge is
property and I need $1 million to finish the business plan.
Stay with us. We'll be right back. A motivated seller just filled out your web form. If you call back within 5 minutes, you're nearly 4 times more likely to get that seller appointment. But delay your follow-up by even just 10 minutes? Forget it. You're toast. Ella Vista Connect calls that lead back in 60 seconds, qualifies them, and schedules your meeting. Find out how much slow follow-up is costing you. Free calculator at ellavista.com/underground.
There you go. Exactly. Yeah. The idea is, hey, we don't want to go get new bank debt because it's more expensive. And hey, our investors are a little spooked, or, we've tried a capital call, it didn't quite work. A lot of, accredited investors, they just don't understand what a capital call is. They don't understand, is this a good deal or a not good deal? It's hard because they're not professional investors to distinguish between the two. And so then the sponsor's stuck. It's like, if I don't get capital, I can't do anything and the deal's going to go bad, but I know I have a good deal here if I can make it through.
Yeah, I was on the other end of that with a capital call about 6 months ago. And, I understood the numbers, but it felt like I was throwing good money out for bad. I really probably wasn't, but I absolutely understand the value that you bring. All right. Okay. So then once the deal is done, now how do you get your money back? Are you just in, second, third place in terms of how people get paid back, and that's why you're able to charge a little bit more of a premium?
Right. So generally we won't come in first position. Periodically we will do first position loans that are more like gap funding, and say they got to close a deal, but either the senior lender fell out or it's too quick of a time frame. We can go and help them close the deal while they go shop the debt and pay us off in, say, 90 days. That happens periodically. Those are great too, because they're usually lower leverage, we're secured, and it's a short kind of time frame of getting paid off. And a more normalized deal where, the example we're talking about, or another very common example we're seeing, is a new acquisition with a loan assumption, right? So it's a very popular transaction right now where you're going and buying an asset at a good basis, and it has a Fannie Mae or a Freddie Mac loan associated with it that you can actually assume as a new borrower at a low rate. So we have one right now where we're investing in, it's got a 2.9% interest rate on the senior, and it's a great asset in a great area, a multifamily property. The only problem is the senior debt is at a 45% LTV. So it's very low leverage. So we can kind of come in, and in that scenario, we're bringing it up to about 60% loan to value. So our last dollar in is only 60% of the capital stack. They still have a lot of equity above us.
Right.
And the business plan there is, hey, they have 3 years left on the senior loan before it matures, so they can go finish the business plan, and then they'll refinance us, or they'll sell the property to pay us off, pay our fees and interest, and we can help bring up the overall leverage. It helps their investors earn a little bit more, and that's how we get paid off. So it's usually we're always looking to. We're usually at a 2 to 3 year kind of time frame, and we either are going to get taken out through a refinance or an early sale.
Gotcha. And so are you charging an interest rate that is payable on a monthly, quarterly basis, or are you accruing and getting paid on the back end on that liquidity event? Like, how does that work?
I get paid when I come in, get paid along the way, and get paid when I get out. So every which way. So we usually charge an origination fee. We have a current pay portion of what we're doing, usually somewhere in the 6 to 10% range.
Okay.
And then we have a back end fee that accrues and gets added on to our principal. And then we have usually some kind of exit fee as well.
Gotcha. Okay. All right. So you're not basically crushing cash flow. You're simply infusing cash, giving them a little bit of oxygen so that they can get to that liquidity event. I gotcha. Totally makes sense. Okay. So I'm always curious about process systems and teams and all that. So what does your team look like?
Yeah. So my background is actually as a commercial banker. I was an underwriter and a banker for a long time before I came into the private equity side. So this is really kind of core expertise for me. And then our team, and we have 30 staff, over half of them are involved in the debt part of our business. The other kind of piece that we haven't brought in-house yet, but likely will, is legal, right? Because in this space, being able to negotiate and understand the legal docs and the operating agreements, it's kind of everything, right? And making sure you have the correct rights and the correct mechanisms to execute those rights. So that's where we've been, we'll likely bring that in-house later this year, but we've been working with great third parties to work with that right now. And we've got a full back office, full asset management team, and origination team. So
back office, does that live here in the States? Does it live offshore? How does that work? I'm always curious about, firms that use like for virtual assistants and.
Yeah. So one of our founding partners kind of ran the finance side for most of the past 10 years. And it's only been really recently where our business has got more complicated as we've done more things. Sure. Right. And it's like, hey, I don't want to be doing more work. I'm trying to, do less and be more impactful. So we've actually hired a controller internally who comes from a Big Four auditing firm. And then we've allowed that person to actually hire out a whole staff under them to do it. And so we do have some virtual assistants, really bookkeepers, but you're not going to get the like high level strategic insights that you would get from, someone that's a CPA and accountant that's, here in the States. And maybe you can get that. I'm not 100% sure, but it's, in our experience, it's more difficult, right? And no one's going to know your books as well as someone that works for you. And so, it's not everyone has to start there, but we obviously didn't start there, but I think at a certain point, it makes sense to bring that in-house.
Interesting. Okay. I'm just curious, at what point does it make sense as a person who's launching a firm, a fund in a couple, well, by the time this is live, it'll be, by the time this recording is live, the fund will be live.
Yeah. Awesome. It's kind of funny you asked that because I work with a lot of different sponsors, both from, the deals that we do as our preferred equity investor and also a co-GP and raising capital. And honestly, I've found it being the biggest weakness for most operators.
Really?
It's the biggest gap, right? Because you can be a good originator, you can be even a good asset manager, but if you don't have good back office, good reliable books, and even understanding like what the property manager might be sending you if you're doing more of an asset play, it's to me, it's everything, right? And you can solve so many problems that don't have to become problems if you have just good financials.
Right.
And so I tell people, as soon as you can reasonably pay the freight, do it, because you're never going to regret it. And it's going to buy you back a lot of time. It's going to make everything you're doing a lot better. And I think it's where a lot of people miss the boat. Like when I was a banker, it was a crazy stat. I think I'm going to get it close to accurate, but it was something like I did a lot of like small business loans, like SBA type loans, and 75% of businesses that failed, right? There's a high number of businesses that fail every year. 75% of them did not fail because a lack of revenue is actually a lack of cash flow. It literally just couldn't bridge between when they had to pay the bills and when they received the revenue, right? And that's where I think a lot of people get into trouble is they don't have an understanding of that gap.
Absolutely. Yeah. It's interesting. I see that a lot. in in my part of the world with the investors where, they're collecting, their revenue shows up somewhere between the 1st and the 10th every month, but their bills show up the 1st, the 7th, the 14th, the 21st, the 28th, right? And, most of these guys are vendors that need to get paid. There aren't any terms. So you're paying, you receive an invoice on one day from a plumber and you're probably paying them, that day or very soon after if you want to keep that person returning your phone calls, right? So
100%.
yeah, it's a challenge. It really is a challenge. That cash flow play is, I mean, even early on, we struggled with that. I was nodding when you were saying that because I was like, oh, I know exactly what that looks like. That was me, 10 years ago.
Right.
So, all right. Well, hey, I appreciate that. So, we are about 20 minutes in, so we're gonna move on to the final four. It's appropriate given that we are recording on the Thursday at the start of the NCAA tournament, and Ben is a KU fan, and I am a Villanova fan, and there's been a history there as well.
That's right.
Fortunately or unfortunately, Ben's guys play tonight. My guys are already done, so we'll just let that go. But it's been a good run. So, with regard to this, 4 questions I want to ask. I really want to understand kind of what makes you tick and how you operate on an individual basis. So, finish this sentence. My purpose is.
Yeah, it's probably multi-layered, but from a business standpoint, I think really democratizing access to alternative investments. I have a big passion for helping people that are newer to investing in real estate and other types of alternatives understand what's out there and the access to it. So I think there's been a huge sea change the past 10 years with some other regulations that have allowed accredited investors to invest in the things that we're doing. And I think we're just the beginning stages. So I hope and expect that to continue. And it's from my podcast, Invest Like a Billionaire, is one of my passions, just education around these types of things. So that's probably the main thing in business.
Love that. Love it. So, invariably executives like yourself have mentors and coaches along the way who've kind of thrown an arm around you. So I'm curious, either at a personal or professional level, what's the best advice you ever got and who gave it to you?
Oh man, there's a lot of good advice. I think fail fast and fail forward is something that I've always kind of clung to. I think, from my background, I wasn't always an entrepreneur, right? I mean, I've been entrepreneurial, but I spent a good amount of time in kind of the corporate world and banking, like I said. And that's not usually a mantra that, bankers would say is, comfortable, right? But it's something I think as an entrepreneur, as someone who is trying to pioneer certain things, like you're going to make mistakes. Sure. That's okay. Just make sure you learn from it and make this feedback loop very, very short and make them quick and make them early. Because I think if you let problems metastasize, it gets a lot worse. The other thing I would say too, like for people that are maybe listening and more career oriented, because I spent a long time kind of in the corporate world, is always provide more value than you're getting paid to do. And I think that can apply not only as an employee, but in any scenario. Like with us, we have investors and just other counterparties in our businesses, like always adding more value than what you're getting paid to do. And with that mindset of always leading with value first, I've been shocked at when you play the long game with that, it always comes back. It always comes back. And indeed. So that's something that's been really helpful in my career.
Yeah. My mentor of mine, the CEO of a company I used to work for, Rob Bernstein, he told me once, look, every human being that we have under our employee, it's a value exchange, right? Mm-hmm. They're bringing their skills and talent and hard work, and we need to see a return, or we either have to make a change or, make a change. So, it's an interesting, looking at human capital and how much value you need to bring to the table in order to, frankly, justify the income that you're making is a big deal. So leaders almost universally tend to be readers. And by reader, I mean consumers of information, whether that be books, audiobooks, YouTube videos, conferences, whatever. So I'm curious, how do you take in information? And what authors or creators are you paying attention to these days? What are you getting a lot out of?
Oh man, that's great. Yeah, I love podcasts, but I love reading, and it's really became more of a discipline. I wouldn't say I loved reading early on, but I've grown to love reading. I'm not a huge audiobook guy just because I like to feel it and to be able to engage with it a little bit more. So usually reading physical books, I usually try and read 15, 20 minutes in the morning and 20, 30 minutes at night. So those are kind of my times. But yeah, a couple of books I'm reading right now. One it's really helpful from a business standpoint is by Buy Back Your Time by Dan Martell. It's been a really helpful. I've just been getting very, very busy. And as we keep growing and adding more staff and more things, I have no time. So learning how to find ways to buy the time and to create more space has been very, very helpful. Recently I read 10X is easier than 2X, really, really cool frameworks on growth. I love reading a lot of historical biographies and other things too. And so I'm always have a couple of those in the circulation too.
Yeah, give you a little perspective. All right. And the final question of the final four: success means to me what?
Man, I mean, family's everything to me. So being a good husband, good dad, and leaving a legacy for my family and kids down the road. And I'm still young, but I'm already thinking that way and don't want to waste any time that I got here. So
yeah, well, it is finite, right? You know, my wife told me, so we have our girls are older. We have a 21-year-old and a 16-year-old. And, you know, she had said to me a long time ago, she goes, we only get 18 summers with them, right?
Yeah.
And that was like, boom, right between the eyes.
Yep.
And it turns out I like these kids. So I want to keep them around and make sure that I'm around for them. So that's a good thing.
Yeah, that's awesome.
All right, man. So when not talking about real estate and saving the world from bad debt and poor operators or challenged operators, let's put it, what do you like to do?
You know, I have 4 kids, so I don't have a lot of free time, but I love anything to do with fitness, sports. I'm big into pickleball right now. Love cooking. Actually, I wanted to be a chef growing up, so that was like going to be my dream. Ended up thankfully not pursuing that career path. And then music. I'm actually a musician and a songwriter, so I always love making music too.
Excellent. So if someone wants to learn more about you or your firm, what's the best way to do that?
Yeah. So I mentioned our podcast, Invest Like a Billionaire. Also, our private equity firm is aspenfunds.us, and you can see some of the things we're working on.
Awesome. Ben Fraser, thank you so much for your time today. And it was a pleasure finally catching up.
Awesome. Thanks, Ted.
My pleasure.
This has been the Real Estate Underground. Don't forget to subscribe. It helps us grow. Until next time, Undergrounders, remember your real estate journey begins with a simple step forward. Now get to it. Bye for now.